This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 202. So 2 weeks ago, we had Professor Fama. This week, to follow up in a similar vein, we have Antti Ilmanen join us, who just wrote an incredible book. Investing amid low expected returns, making the most when markets offer the least. Very good book, very solid book, and this was one solid conversation.
Yeah, this is a great conversation. Antti actually listens to the podcast, and when I said at the end of our conversation that it was a great conversation, he said, "Yeah, but you always say that," which maybe is true, but we have a lot of great conversations. And like you said, Cameron, this was right up there. Antti is the co-head of the Portfolio Solutions Group at AQR, which many of our listeners are familiar with as a firm. That's Cliff Assets' firm. So Antti advises institutional investors, and he develops AQR's high-level investment ideas, which is largely what we talked about in this episode, or at least what we spent a lot of time talking about. He's got his PhD in finance from the University of Chicago, and he studied under Fama and French. They were the co-chairs, I guess, when he was doing his PhD. And Cliff Assets was a teaching assistant. And,
crazy.
Yeah, it is crazy.
And we back in the late 80s, right? 88, 89, he told the story.
89 is, I think when he went. And there's a little kind of outtake story that we stuck in at the very end of the episode, so make sure you stick around and listen to that.
He also had some really good advice. Like, he talked about cultivating your patience. One piece of advice he gave was view your portfolio broadly and rarely. That's near the back end of the conversation. It's some real practical advice, which I really enjoyed. And there's a lot of big takeaways. Like, he talked about how this conversation about fee pressure in private equity investments after lower returns, which is really interesting.
Yeah, it's like private equity has low expected returns now because a lot of new assets have piled in, but the fee pressure won't come until later when realized returns are lower. So expected returns come down because of flows. Realized returns won't be low for another, whatever it is, 10 years, and the fees won't come down until the low realized returns have happened. That was definitely an interesting point.
So this book, which, as I said, is a great read, is available on all platforms, including Amazon. They also set up a website that Antti told us about at aqr.com/serenity, which has excerpts from the book. Cliff Assets wrote the foreword, and he also includes on that website deleted what he calls scenes that were not included in the book because he had to keep the book below 300 pages. So
he said Cliff bet him that he couldn't keep it under 300 pages and said he would only write the foreword if he did.
Yeah. Anyways, I loved this conversation. Learned a ton. It was really fun. Anything else, Ben?
No, I agree. This most recent book from Antti is fantastic. His first book is similarly fantastic. Worth a read just for the historical data that are in there. But also the overall context on what alternative risk premia are and how they behave relative to the market, including the theory and why the premiums should persist or the economic logic behind who's on the other side of the trade, which is also something we talked about in the episode. But yeah, overall, two phenomenal books and similarly a phenomenal podcast episode.
All right, so with that, let's go to our conversation with Antti Ilmanen.
Antti Ilmanen, welcome to the Rational Reminder Podcast.
Thank you. Looking forward.
So are we, very much so. Maybe just a quick note, actually. Your first book has been, for me, very influential, and your second one was also fantastic. So very excited to be talking to you.
For sure.
All right, so to kick it off with the first question, Antti, does long-term historical data contain information about expected returns?
Yeah, it does. If expected returns or some premia, if they are constant over time, then long-run historical averages are our best estimate. But if they vary over time, these historical averages are less useful. And then it's often better to study yield-based forward-looking estimates.
Under what circumstances can historical data be misleading?
Well, so even if these expected returns are constant, the sample average is a noisy estimate, and it's moreover, it's distorted if you've got big valuation changes within the sample. Fortunately, it is possible to adjust for these sample-specific valuation changes. Let me make this concrete. Like, if you think of last 10 years, S&P 500 realized 14% real return, while 10 years ago, the expected real return based on starting yields was about 4 or 5%. Well, we know that the Shiller price-earnings ratio, or CAPE, almost doubled from 20 to 40. And the resulting windfall gains were almost 7% per year. So we could subtract that 7% from the 14%, and we would sort of start to get to the right ballpark. But anyway, that's sort of a bad example, because one 10-year history is just one observation, really. So we need much longer histories to cancel sample-specific noise.
So you mentioned something important there, though. The earnings yield at the beginning of the period was very different from the realized return at the end of the period. Historically, in the full sample, how predictive are current yields of future realized returns? Yeah,
well, the good news is that they get the sign right. So it's better to look at that than last year's the 10-year return and extrapolate from that. So low equity yields predict low future returns. The bad news is that this forecast is quite noisy for the next year. So, there's this is not very useful for market timing, but even for a 10-year horizon, there's a fairly large uncertainty band of several percentage points per annum on this point estimate that we all quote. Actually, like Cliff Asness, my boss, I and Tom Maloney, we wrote an article a few years ago where we showed how difficult it is to use equity yields for market timing. And the theme was, if market timing is a sin, then at most sin a little. And the intuition there was that it's very common to show some charts where there's a nice relation between starting yields and next 10 years future performance. But the caveats now are that there are very few independent observations. The statistical relationship is very weak. And then if you try any contrarian market timing rules using these signals, they have pretty underwhelming historical performance. So in practice, I think it's good to think of this cliche that if you are trading with contrarian signals, you too often tend to be early, and early equals wrong. That just has happened too many times for good investors. Anyway, so now I was focusing on the cautions. I would still say that these yield-based estimates are pretty much the best we have for next 10 years expected returns. So they are useful anchors, and therefore today's low expected returns are a grave problem, especially for young retirement savers.
Interesting. So to follow on to Ben's question, when you estimate expected returns, how much weight do you give to the historical data versus forward-looking, market implied expected returns?
Yeah, so no easy answer. The more evident it is that there is time-varying expected return in a way that you can measure, the more I lean on forward-looking data. That almost sounds like circular, but certainly for bond yields, you can see this. But I'd say you can see this for equities and other long-lived assets, real estate, and perhaps for value stock selection strategy. For some other factors, I think this would not be too helpful. And I'd be especially wary with using historical average returns in a situation where we know that current starting yields are far away from historical average yields. Then you sort of know that there's something off in using that historical average.
Would you, what we do, maybe I'll ask the question this way, what we do for financial planning purposes is we combine the historical premium with the current market implied expected return and weight them based on the historical predictive power of the CAPE. Does that make sense?
It does, with the only caveat that we have got very few observations, even of like if you have 150 years of data, which sounds like sort of, do you really trust that the world was stable in that time? That still would give you 15 independent observations, lots of noise. But still, again, we are in an imperfect world. Sounds good. Yeah.
So based on the current market implied or the earnings yield, how low are expected returns?
Yeah, so I'll focus on US equities and ignore some sort of quibbles. There are lots of ways of doing this, but if we take now this Shiller price earnings ratio as a good way of not just thinking of valuations, but flipping it around and thinking of that as an expected real return, then I think yesterday's Shiller PE, I just checked, it was 33-ish, I think, which conveniently sort of says that you flipping it around 100 over 33 gives 3%. So that's that would be a simple answer. By the way, then the important thing is that when you look at last decades, 40 years ago, it was 10%, and we have seen the decline to 3%. We've gotten these beautiful windfall gains for equities, and I call it, we have effectively borrowed returns from the future. We have capitalized sort of the future cash flows now at very expensive levels, and that's sort of good for current asset holders, but it really effectively it locks in those low future returns, and locking is sort of advisedly used, because I just told that we predicted 4% and we saw 14%. So the forecast error is sometimes big, but it's still that's the right base case, and so I think we have got these low expected returns that will materialize sometime, but we don't know whether that's going to come through what I call slow pain or fast pain. And we are now having this clearly a fast pain scenario, but the alternative would be that we would always have these very low starting yields, and we would be sort of doomed to clip tiny coupons without any benefit of the windfall gains that we were used to in recent decades.
Are non-US equity markets comparatively cheaper?
They are. US stands out based on CAPE or any other metric, I think, rich compared to other markets, both developed and emerging. Some of this reflects different sector decompositions. Maybe doesn't matter, but it's sort of an interesting consideration. And partly it's explained by that, but partly it goes beyond that. So, for example, the larger tech sector and rich tech sector in the US.
You talked about market timing earlier, referencing your paper, which I love on that topic. It's a fantastic paper. Does it make sense to tactically shift into higher expected return equity markets like international markets as opposed to US equity?
Yeah, it can. First, maybe just clarify that we talked about market timing a little, and now what you are describing then is a contrarian country allocation strategy. And it's important. Like sometimes we hear that people are not quite clear of the differences even between market timing and then value strategy cross-sectional. So let's just think that contrarian strategy can be done at market timing level on S&P 500 or global equities. Then we can do country allocation, what we are talking about now, or then we can go to stock picking and do value versus growth type of strategy using HML. So back to that question, I think in the long run, this kind of country allocation strategy has been moderately profitable, but it doesn't have a great hit rate. And if you look at, again, last decade, US has been looking expensive and somewhat getting more expensive most of the time. So this is another example of the difficulty of using contrarian signals. Much patience or luck is needed with them. One day it will work, and so odds are in your favor, but the odds are not greatly different from 50-50.
So let's shift to fixed income and a question that Ben and I get often. So with bond yields being lower negative, are bonds dead as an investment?
Well, I learned in my pharma class 32 years ago that bonds can offer an interesting term premium as long as yield curves are upward sloping, and that they can be an interesting sort of negative beta asset even with no premium, and you might want them if they are good recession hedges. So those lessons, they've been later refined, but the broad message I think still applies. Bonds could have a return generating role, and they can have a very valuable diversification role, and they certainly had that in recent decades. Now in the current situation, we've got the heightened inflation situation, Fed tightening, and we are starting from still somewhat, well, no longer as low yields as a while ago, but still at yield levels where people see lots of upside potential. But such views, then that's getting to duration timing. By the way, I did write my dissertation pretty much on duration timing in Chicago. And it's funny, sort of every decade I'm getting less confident about mine or anybody's ability to do that well. But wow. So on that is it dead? On that mortality jargon, I'm just thinking duration timing trades were initially in Japan and later elsewhere, they were often called widow makers, because people were betting on the rising yields, and that never happened. And so this year it is happening, and so great, finally. And okay, eventually those rising yields will revive the corpse, and then we should be having more interest. Everybody should have more interest in bonds by that time.
That's pretty funny. What people think is making bonds dead is actually reviving the corpse. Yeah.
Interesting.
You mentioned term and credit. Is there an expected credit premium? Is there an expected premium for investing in corporate bonds over government bonds?
There is on historical data, and I'm like you can go somewhat further back, like even 1920s or further. But I'd say you have got decent quality data on corporate since 73 maybe, and really from late 80s. But over these periods, and certainly before, but I just don't trust that data, there was a positive reward. And you can think that it's partly a default premium, illiquidity premium, and there are often some tax rationales. And a further thing is that it is quite highly correlated with equity premium.
Interesting. Okay. Because I've seen a few papers that kind of suggest if you duration match and option adjust and all that stuff, then the historical credit premium goes away. But you're saying in the more recent data, it is there?
Yeah, so my colleagues had a paper a few years ago that which clearly, I mean, they made the right type of things, looked at regression, whether when you put equities and treasuries and then corporate excess return there, whether it shows up as useful thing, or another idea, you can put this into optimizer and ask what an optimizer says. So they found a good role for credits, and you can intuitively think that maybe they have got somehow the illiquidity premium and maybe different volatility exposure than equities that could justify it. But they did this analysis with data going back to, I don't know, 1930s or so on. So I'm a little cautious of that, but I am thinking that there's some role for credits beyond govies and equities. This is different actually than what I wrote in 2009, but I saw new research that made me change my mind.
Interesting. So something that I learned from your most recent book, which actually surprised me quite a bit, is that there's a long-run commodity premium. And the reason it's surprising is that theoretically you'd expect low returns, similar to what you're talking about with bonds. They've got lower negative beta, therefore low expected returns. They've also had low realized returns. And then the other thing I learned in your book is that individual commodities have had a 0% realized return on average, but commodities as a basket have had a positive premium. Where does that premium come from?
Okay, yeah, this does get very geeky. It's sort of a lovely topic for a niche audience. So I hope we don't lose too many people in the next.
Don't worry. This is a very geeky audience. Don't worry.
Okay. So to understand it, you must be aware of the difference between arithmetic and geometric means. So simple and compound returns, and there's always basically a positive gap, and that gap widens with volatility. It's often called a volatility drag or variance drain or something like this. Basically, assets with high volatility will have a big gap, and the intuition is that large fluctuations eat up compound returns. So sort of if you start with $100 and you go up 50% and down 50%, you are not back at 100. You are down to 75, and this effect gets bigger with volatility. Okay, so now in the case of commodities, single commodities have quite high volatility, typically near 30%. So their geometric mean is well below their arithmetic mean. And the geometric mean in our long data set is typically near zero. So you can actually like think, if I can visualize it. So typical, some commodities have had a long run history compared to cash that they outperformed. Others had negative, but on average, it was something like this. So that's the case for individual commodities. But when you create a portfolio of them, you get this. And so you get, and for listeners, you get basically something upward sloping. So there's something like 3% commodity premium coming from the fact that you are reducing portfolio volatility from near 30% to below 20%, and you are reducing this volatility drag. And this sort of weird technical feature gives commodity portfolios this extra return. And this mechanism is actually like known for quite a long time. There was a paper by Fama and Booth talking about diversification return. Others call it rebalancing bonus, and it is available in every asset class. It just is much bigger in commodities with high volatility and low correlation combination, which makes it so much bigger. And most memorably, so Cam Harvey dubbed this effect turning water into wine. And so the bad news is that such a magic is sort of, I don't know, it's maybe hard to convince investors that this is a sustainable premium, the same way you would think of equity premium. But I do think as logics, so you mentioned that it's a low, but it has got some market beta and growth beta. So those I think are one argument. In addition, commodities have got lots of idiosyncratic risk, and you can make a case for some hedging demands that would justify it. Those would be sort of the rationales why this happens.
So what effect do illiquid assets like private equity or direct real estate investments have on expected returns?
Yeah, so they are obviously super popular assets nowadays. Investors are sort of flocking into that area. And one of my key arguments is that illiquid private assets may not earn as big premia as is commonly thought. One intuition is that for any amount of fair illiquidity premium that you should get for locking money away for 10 years, that may be offset partly, fully, or maybe more, we just don't know, but surely will be offset partly by another interesting feature of privates, what I call the smoothing service, lack of mark to market. So we will accept not the full liquidity premium, but something much more modest for the fact that there's something very nicely smooth. Like I highlighted that if you compare Cambridge Buyout Index with a public proxy, small cap value stocks during the GFC, you find that one had a drawdown of 25%, another one had a drawdown of 60%. Which one would you prefer? And then I'm saying that then you should expect some pricing implications for that. And so I think investors are very, I don't know, they are always nodding when I tell this story. They sort of think of themselves in the mirror, and this is the way I view as well. So that's the sort of logical thing. And then when we go to data and ask how big illiquidity premia do we see there, we see actually very modest premia when we get to private assets. The longest history that which is, I would argue, decent, is since 1978, we have got US direct real estate compared to listed REITs. And between those, there's been a negative premium. So the more liquid asset has outperformed. But there are beta differences, leverage differences, sector differences. When you adjust for those, you may get closer to zero, but you never find a positive illiquidity premium. And something similar, not as extreme, but with private equity, there is, I think, evidence that especially in the last 15 years, there has been quite a modest premium between private and public equity. And again, I would link that then partly to the inflows into the space, but also just to this idea that investors really appreciate this other feature of private assets.
Yeah, I love the term smoothing service. That's good. I haven't heard that from you before.
Yeah. By the way, I just thought maybe for your mindset, the other interesting point with these inflows is that the popularity of those assets means that we don't get the fee pressure in private equity that we've had with hedge funds. And so we are in a world where with lower expected returns, but that's a space where the fee pressure, I think, will come only after we I don't know, investors eventually learn that the return advantage is not as great as you see. You learn more slowly in such assets as private equity.
Wow.
So let me make sure I understood what you're saying. You're saying that expected returns may be coming down because of inflows, and so valuations going up, but the fee pressure will come later once realized returns are low.
Exactly. Because so in reality, those private equity manager who faces lots of institutional investors and maybe democratized participants as well on the door can say that, oh, you don't like my high fees, I got many other people here. So again, you have to have a different competitive balance between them than we see now.
That's very interesting. I think you guys had a paper on illiquid assets, and this is where you talked about this. And I think there was a relationship between valuation and realized returns as well, right?
Yeah, but when we talk about S&P, we have got more data when we talk of Schiller P and S&P 500. Now we are talking of many fewer decades and very smooth data. You get, I don't know, 3 observations, not right. Very useful to do any statistics on those. No.
We're in Canada, which is, as you may know, one of the hottest real estate markets in the world right now. Are the real estate returns of recent decades indicative of real estate's expected returns?
No, they are not. Remember what I was talking about, the richening valuations boosting realized returns of bond and equity returns in recent decades. So something similar has been happening in real estate globally, and I'm pretty sure, especially then in Canada, if you've seen this particular richness, and I've seen in The Economist some of these signals there. So instead of looking at the rear view mirror and extrapolating on past returns, which were boosted by windfall gains, here too, I would rather try to look at forward-looking returns, some yield measures, and it's hard, but they should be available somewhere. So in general, I'd look at, I don't know what the terminology there in Canada is, but I'll call it rent-to-price ratio. So I would use rent-to-price ratio as current starting yield. Are they similar to long-run average? If they are not, and I bet they are lower, then don't expect those historical average returns, which were anyway boosted by those windfall gains. So I am not an expert on this, but my best reading of the literature and thinking of what's happening in other asset classes is that a decent forecast for future real return for real estate is the rent-to-price ratio, which should be adjusted for the costs or expenses, which are often a third of the gross yield, or if you have got a real free cash flow yield, that would do the trick. So if that's the best estimate, this means that we assume the unexpected returns for equities also. You can think yield and growth and expected change in valuations. Now I'm saying the same. I'm saying let's just look at the yield and ignore growth and ignore expected change in valuation. So the book writes about literature talking about historical real growth of rents, and this is mainly US, real growth of rents or quality adjusted house prices. Some studies find small positive, sometimes some find small negative. But I think 0 is a pretty decent base case estimate there. So expect just 0 growth. You just earn your yield, and then we don't assume any changes in valuations. So we don't extrapolate ever more richening, but we also don't expect mean reverting valuations, which, if anything, I would say is more plausible now that we are in this rising yield environment, rising bond yield environment.
So you mentioned investors are flocking to illiquid assets. Can you talk about how institutional investors might be responding to lower expected returns or have been responding?
Yeah, it varies, but the most common approach is to take more risk. Investors want to keep earning the kind of returns they are used to, instead of, like I used the serenity prayer in my intro, so I'm saying they don't serenely accept lower prospective returns and tighten their spending plans. So this could be done through higher equity weights, which Norwegian Sovereign Wealth Fund did, or some allocations to styles or factor premia, or the most common choice, raising the allocations to alternative asset classes such as private equity, private credit, and real estate.
Does this cause you any reaction, any concern?
Well, I already told, I think there's going to be an impact that those you should expect lower returns in those places as well. And maybe the one concern is that there's often, I don't know, apparent disconnect there, that people don't see these types of logics as well in those markets. But it is a world where everything is expensive. So I think you can make fairly this choice that you take more risk as long as you do it with open eyes, and then you can debate which of these is the best one. The smoothing feature that I said, I think there's something you can criticize about it, but it does help investors somehow be more patient. And actually, I have said sometime that thinking of Canada pension plan, that 85% equity risk, if that, even for them which are clearly good long horizon investor, if all of that was marked to market, I don't think the number would be 85%.
Yeah, that's probably true. Now, in equilibrium, taking more risk can't be the answer, right? Because not everybody can take more risk. Is that the right way to think about that?
Yeah, it depends. It depends on, of course, what sort of issuers would do. Like in principle, it might be possible that there would be catering of that demand. But I think it's fair. I think it's typically it's a good way to think that you can't have, crowding at the aggregate level. Valuations have to adjust. So I'll just tell this, that like if you think of a situation like October 87, or could be this week, or could be March 2020. If everybody becomes more risk averse, we can't all run to the exit at the same time. Asset prices need to fall. And the flip side is that when there's growing demand for something, valuations have to adjust. Or the other possibility is that the issuers come to the other side and offer you something.
How do you think the low expected return environment we're in now will impact the required savings rate for individual investors?
Yes. So we wrote a paper a few years ago where we tried to make tangible this impact of low expected returns for individual retirement savers. In that case, it was for USDC savers. But the point, I think, generalizes. So your eventual pension pot depends on the savings contributions you make, or somebody makes, might be employer, but savings contributions, and on the investment returns on those savings. And if the market does less for you, you have to save more. So in this paper, we plugged in plausible assumptions, and we came up with estimates that in the good old days, with sort of normal long-run expected returns, it was enough to save, let's say, 8% from your paycheck. But if expected returns sustainably fall by 2%, the required savings rate to reach the same target doubles to nearly, or almost doubles. So I think 15% was the number, 8 to 15%. And again, details you can plug in a bit different numbers, but it's really a first order impact on required savings rate.
So if we set theory and long-term evidence aside, value's been going through a pretty rough patch of late. So has value ever gone through a period this bad before?
Yeah, I do have that in the book as a small detail. The data before, you have to go before CRISP data if we are talking of the sort of Pharma Friends book to price HML. So it didn't happen since 1926. Some big ones, but not quite this big one. But earlier studies show a pretty comparable value drawdown between 1890, I think, and 1904, and that was the time when there were big monopolies, Standard Oil and others in the US, and this period ended roughly with the pending antitrust legislation. So it is interesting to consider the parallels now, which could be headwinds for FAMAG type of companies. But I do want to stress that. So I think any version of value has had a huge drawdown in recent years. But what press often refers to then this 14, 15 years drawdown, that's pretty specific to looking at sort of the classic book to price Pharma Friends without any industry adjustments. If you try to do more apples to apples within sector, within industry type of value trading or multiple signals, look at outside US, you often did okay still in 2010s up to about 2017, and after that had this very bad performance. But again, 5 years as opposed to 15 years drawdown seems more appropriate.
I think it's unknowable, but I want to ask anyway. Do we know what caused value to perform so poorly in the last few years?
Yeah, so we've studied so many different culprits. We have thought of some, and others have been offered to us, and that list is actually long. And I'd say many proposed causes are weak. One famous one is that it's low yields or falling yields, and so there's a little bit of empirical roots for that, but it really both logically and empirically that can't explain much. I think the best single explanation I'd pick then would be sort of loosely this structural change that we have seen from physical to digital, which has favored many young disruptive companies. And it probably started with some good fundamental roots 10 years ago or whenever, but by late 2010s, it had degenerated into an irrational bubble, and I hope Pharma isn't listening to this one. And so markets repriced growth stocks higher, not just in tech but in many industries. And you could ask, maybe that could be justified by fundamentals, better fundamentals. So typically growth stocks have better growth fundamentals than value stocks, but market discounts too much. But even that argument that they were exceptionally good environment now for growth stocks doesn't hold water. So we've tried it in so many different ways, and typically we find that it's sort of with anything measurable, it was the other way. It really wasn't possible to justify this repricing. That's why we would call it a bubble. And of course, we have seen recently some deflating of this bubble, but forward-looking value spreads suggest that there's more runway to go with that.
The post where you guys compared value and growth fundamentals over time and showed that wasn't the explanation for that. That was very interesting.
Yeah, and there are many ways of doing that. Again, like it's and every way we try, it is. Yeah. Anyway, it's something. I don't know. Yeah. At some point, then you become more confident. You rule out everything else, and then you get to say, okay, looks like a bubble.
On rates, you guys had a paper where you found that statistically the relationship just isn't there, and in other samples it just isn't there. And so I kind of took that and said, okay, that's fine. The relationship just kind of looks like it's there if you look at a pretty picture. But rates have been rising recently, and growth has been getting hammered, and value's been doing okay. It's interesting. Yeah.
So let me say that. So it's fair to say that the relationship between various rate measures, you can again look at many different measures, but that has increased. The correlation used to be close to zero, and now it might be 0.3 or something like that. But so it has increased. And I do think that it has been such a, media story and investor story that for some time markets can act as if this relation was deep and meaningful and it's going to be there always. And so right now, I think that relationship is there until it somehow weakens one day, and we're going to have less. But basically, this common belief that there is this pattern, I think does probably contribute to something. I mean, that's a weird way of thinking of markets, but I think that probably has been happening last couple of years.
That's super interesting. So even if it's not a real thing, it becomes real because people believe it is so.
Wow.
Yeah.
Huh. So is it possible to generalize when major value drawdowns like this tend to happen?
Yeah, well, first, it's pretty much in hindsight, but logically, structural changes are bad. So, value and contrarian strategies, you expect some normalization. If you get a structural change, that's sort of bad news. And they're often related to technological advances. And I think, again, they can be things that start sort of rational, and then they may degenerate into something less rational. Sort of this time is different, and you take things too far, like Nifty 50 phenomenon 50 years ago, .com 1 25 years ago, the .com 2 recently. And when these things happen, they create major headwinds and losing phases for value. But on the other hand, it hasn't stopped value from working over 200 years in stock selection or in other asset classes. Temporary headwinds, although they can be, again, so painfully long that really matters for investors. So I think that's the main answer. But maybe another interesting question or way to address your question is there equity market beta in value strategy? And the answer is that not a consistent one. That if you think of recent period, or you think of post-.com 20 years ago, value had a negative beta. It did very poorly in bull market and then very well in the bear market, which is a lovely feature, of course. But then when you think of 2007-8, the beta was actually positive. Value strategy suffered when the market was falling. And over long histories, if I look at rolling correlation or beta of so market beta of value strategy, there hasn't been a consistent sign. There has been some of this sign flipping. So I think it's sort of, in the long run, I would think of it as pretty much market neutral, but maybe one can have some idea where, like, clearly, since the playbook is so much like it was 20 years ago, I would expect value to continue to have that negative equity market beta for a while, but in 5 years' time, I have no idea what kind of beta it's going to have.
That's really interesting. So we talked to Bill Janeway a while ago, and he talked about productive bubbles in technological revolutions. So it sounds like we're kind of relating that concept to value and growth.
Yeah. And again, rational underpinnings can be there, and
Is the expected value premium constant or time varying?
Well, certainly, when you look at those value spreads, they vary a lot over time. And then if value then were constant, it would sort of require that all of that fluctuation would be justified by those exceptional growth environments for growth stocks. And that doesn't seem to be the case. So definitely, I think it is time varying, but it is hard to exploit it. Let's go back to the things we talked earlier. Contrarian timing is hard, and early equals wrong. Happens time and again, even to us.
So how do the expected returns of value today look compared to history?
Yeah, very attractive. So, but achieved through blood, sweat, and tears, or lots of pain. So the painful drawdown of 2018 to 2020 brought these expected returns to very attractive levels. So this value spread, you think, so it's a relative valuation of value stocks versus growth stocks. We sign it so that positive number is attractive. That has been very high since 2020. Only really competing, like the only historical competition is around 1999 there. So again, that parallel seems important. And the interesting thing is that that value spread has remained quite wide, even though value strategy has done very well in the last 6 months. And we just keep looking at, we're like, some payback for earlier troubles, that you get good performance, and it looks like the value spread remains wide. And the intuition how it could remain wide is that we are rotating into new value stocks and growth stocks over time. So that's one explanation. It also could be that the fundamentals are moving sort of in our favor. That's another way that can happen. So beyond just looking at the value spread, if the momentum is now in the favor of value, which it is, that can give some good tailwinds to it, and maybe the rising rates, as you mentioned, could do that as well. But anyway, last thing I just say on this topic is that any answer to these types of questions is design specific. There are so many ways of doing developing the value strategy. I mentioned the industry neutral or not, for example, which signals you use and so on, and also many ways of measuring the attractiveness of whatever strategy you chose. But the broad story, I think I said, looks robust to different ways of looking at value.
In your book, you talk about a few different alternative style premia. One of them is value, which we've been talking about. Another one I want to ask about is trend following. Maybe before I ask the question, can you quickly tell the listeners what trend following is?
Sure. So trend following chases past returns is sort of the insulting way, but again, like in some way, the weird thing is it's surprisingly naive strategy, and it's a close cousin to momentum. You can pretty much think both favor investments that have done well in the last few months up to 1 year, and sort of dislike, maybe underweight then investments that have done poorly over this time. The difference between trend following and momentum is that trend followers allow big market directionality. Momentum trading is often like value. It tries to be market neutral, whereas trend followers say that if the whole market went up last year, I'm going to go on beta long in a big way. And in a bear market, I go beta short in a big way. So that's I think. And by the way, that is implemented not just in trading equity market indices, but also bond indices, currencies and commodities. That's typical for most trade. There could be other things, but those are the typical for liquid asset classes. And the odd thing is that you can have pretty similar types of, you diversify by doing this, but directionally you may also have similar things. Like if there's a bearish environment, you may go short equities, long duration, anti-carry in currencies, and favor gold versus growthy commodities. And all of these are sort of risk-off type of strategies.
Now, I understand that one of the benefits of trend following is supposed to be that it reduces left tail risk, but I also understand that in the COVID crash, it didn't do a whole lot to help. Do we know why that happened?
Yeah, I think I can. But let me first tell the broader. So the more positive thing is that trend following has had this weirdly good historical track record of combining positive long-run reward with good performance in many equity market drawdowns. And the intuition how they tend to do well in equity market drawdowns is that trend followers tend to turn then, or can turn from bullish to bearish and ride the bear market and be among the few investments that help you then when you most need it. But this, of course, works especially well if you have got slow-moving, protracted bear markets. And now getting to your question, the Achilles heel is in sudden turnarounds. In practice, those are pretty rare, and the worst historical months tend to happen within a bear market and not at the turn, but sometimes you get the sudden turn. And obviously with COVID, it was quite a sudden turn, and that hurt. But even in that case, trend strategies didn't do too badly. Some lost a little, some made a little, because, of course, equity markets turned pretty much only late February, and then it matters how fast your trend signals respond to that. But some other asset classes of bonds, currencies, commodities may have already been tilted toward risk-off positions. So it wasn't actually too bad. And during this year's equity market turmoil, trend following has had a fantastic situation because things have sort of gone sufficiently gradually. So which also happened in 2008. Can't always work like that. But again, with these more gradual bear markets, trend following is a beauty.
Can you define the defensive style premium and how it relates to quality?
Yeah. So in general, let's focus on stock selection mainly. So defensive and quality, they are sort of both umbrella concepts for this empirical finding that boring stocks perform surprisingly well, and the risky stocks disappoint in the long run. And let's just first recognize that this is a huge puzzle in finance. We learn among the first things in finance, risk should be rewarded. And when you think of stocks versus bonds or cash, risk does get rewarded, and that's makes all the sense in the world. And then when you go within equity market and you look at portfolios with different betas, you could do also different volatilities or some different measures of quality. You find that the riskiest stocks tend to have disappointing, actually worse performance than other stocks. And instead of having this positive relation, there's inverse relation. And if anything, in last decade, for example, it was quite a strong inverse relation. And by the way, so in Pharma Friends 5-factor model, you can think that the profitability and low investment, they are sort of in the camp of quality signals. So again, statistical low risk measures are one way of thinking of this, and fundamental low risk measures like quality, including those two, are other candidates for it. But I'll focus just with the story. I'll just talk it through the beta effect, because that's sort of the theoretically the most important. So it was found already by Fisher Black, the Black and Scholes Black, in early 1970s that sort of there was too little beta reward for beta, and Pharma and Friends found it again in their early 90s studies, and many other researchers, including my colleagues Andrea Frazzini and Lasse Pedersen, found it again in 2000 and took this research much further. And the empirical evidence is super compelling, because it works in most countries. You can look at it find it within most industries. You can take it into other asset classes. Boring stuff earns higher risk-adjusted returns, often even higher raw returns. And then you can ask why, and I don't go into details, but I just say investors' leverage aversion and lottery preferences are the main candidates. Those speculative stocks contain embedded leverage, which investors tend to like, and they are the proverbial lottery tickets in financial markets investors tend to like, and those sort of make them more expensive and imply then lower long-run required returns.
Yeah, that's very interesting. All right, I want to move to carry, which is it's a tough. I have trouble thinking about carry, so I'm hoping you can describe it. And how is carry different from value? Because I see carry and it looks a whole lot like value to me.
Yeah, well, so carry is, we were talking how naive trend is, but carry is in some sense another embarrassingly naive type of strategy, favoring high yielders versus low yielders. And historically, that has done surprisingly well in many different asset classes, just like value, momentum, and defensive strategies we described. And so to your question, in some cases, carry and value are very similar. I think I suspect you are thinking mainly of stocks, that if you think of dividend yield as a value signal, well, it is also, it's carry signal, but it's also a value signal, and not the best, but it's goes there with BP, EP, DP, so that's fine. But in some other cases, they are quite different. So if you think of currency trading, high short rates are what we look in carry. That gives positive carry, and that's not at all. At least it's not mechanically related to undervalued currencies. Sometimes those high carry currencies are cheap. Sometimes they are expensive based on things like purchasing power parity. So the two will be similar if they share what I call the 1/P effect. So 1 price effect. If both carry and value are inversely related to market price, and in many cases that's true, DP, but in other places like currencies or commodities, for example, that's not. So
very interesting.
Mm-hmm. So if all these style premia are going to persist, who is persistently on the losing side of these trades?
Yeah. So I've had a 10-year project with co-authors called "Who is on the Other Side," and I have draft papers over the years, but it's so far they've always lost out to other priorities, and partly because it's a broad and difficult topic. But the main point is that if you believe that a factor is rewarded in the long run, it's sort of you owe it to your to yourself, but your clients also to think about who would be the one taking the other side sustainably. And that question can be addressed either with theoretical arguments or empirically with some flow or holdings data, and both have been done in the literature. And let me I'll take one example. There are not two easy answers to this one, but so you should think certainly theoretically for each of these ideas. So who would be there? And I take this defensive strategy that I just said. it has got very nice economic rationales, I think, with the leverage aversion and lottery preferences. So the other side would be leverage averse investors and lottery loving investors. And then when we go to flow and holdings data, we have got, we are limited by what kind of data is available. But when I sort of try to identify which investor groups might be on the other side, we have found that hedge funds are one group that systematically takes the other side. It's sort of maybe surprising, but they are favoring the more speculative stocks. And so one can ask similar questions for other factors. Think of what's and I've got the table, I think, in the book where I show list of possible theoretical explanations, rational or behavioral, and then separately there's this question of what does flow data tell. And for example, for value, flow data doesn't identify easily a group. There's an academic paper which sort of even asks, so who is on the other side? But in general, I think we know that there are growth managers and value managers and that sort of, but we don't find that all mutual funds or tend to be on one side, all hedge funds tend to be on another, or individuals. So it is within these broad groups, I think, where we find value and growth investors spreading themselves. But last thing I say, that we did find in our research that there is persistence in investors' sort of factor tilts, and that's sort of good news. That's suggesting that this other side, whatever it is, it tends to be persistent and arguably then sustainable.
We talked to Sebastian Bertermier recently, who wrote Who Are Value and Growth Investors paper. Yeah, he's got some interesting empirical work on those questions.
I've seen the value ladder, and I listened to, and I actually asked my colleagues and any other data on this, because they've got this Swedish data set. And so, I mean, this age story is fantastic because, again, I mean, it sounds right, and there is interesting literature. So just for readers, I think the main finding was that when you go older, you become more value-oriented, contrarian. And there's outside finance, there are these things that young people tend to be more open to experience, and the older you get, the more you become stuck with your ways and comfortable. Sort of from exploring, we go into exploiting, and I find that when I'm aging. And so it just sounds so interesting, and finding that in the case of value. But again, don't know of any other study than that. It's with this one Swedish database. I'd like to see something more before I'd sort of, start to do more on it. But I think it is a very interesting result, and hope there will be something more on that in the future.
He does have a working paper using Norwegian data, I believe. It's similarly interesting.
Yeah.
Okay, so the style premia that we were talking about, they're technically long-short portfolios. How important do you think it is to actually be long-short? And to add to the question, we've seen a paper suggesting from a long-only manager, to be fair, suggesting that tilting toward the long side of the premium in a long-only portfolio is effectively equivalent to having a short position in the short leg. How do you articulate the importance of actually being long-short to capturing the premium?
Yeah. I think partly that could depend on asymmetries between long and short, but I think the more important thing I want to emphasize, so long-short applications can allow you to do the purest, most efficient way of capturing some style premia, and then they allow better risk diversification than long-only applications, which are always dominated by market risk. I've heard you ask some visitors there about diversification, and what's good diversification? Is market portfolio perfectly diversified? The problem with that logic is that your portfolio is driven not fully, but very strongly by equity market directional risk. If you allow this long short, if you allow shorting to reduce the impact of market, and you allow leverage to make some other things, could be value, could be many styles, could be other asset classes also. If you let them matter as much as your equity risk, you are letting your portfolio be driven by many other things. So that, to me, that allows clearly better risk diversification. There are problems, I promise I'll get to that in a moment. But so again, my sort of core point here is then that when you allow shorting and leverage, you can get much better risk diversification. If you combine 4 uncorrelated strategies, you can double your Sharpe ratio. And with a long-only world, you just can't do that. Equity risk will dominate. You are sort of only getting small incremental improvements with the common equity market risk. There are downsides. The downsides are that the very features of shorting and leverage are uncomfortable for many investors. And there are limits to how much investors want to do this. The unconventionality of this is such a challenge that I think it can hurt investor patience in bad times, especially. And then I think this type of logic makes me understand why most investors choose to not take this path of better risk diversification, but focus on equity concentrated portfolios with unlevered long-only approaches. And they can still use this style premia, blending market risk premia with much lower tracking error of some style premia as a sort of silver light or sliver over the market exposure. But again, if I do love diversification, and to some extent, I said that if you really want to go that path, then shorting and leverage are needed to take full advantage of it. But I know that this is for, I would say, only a small subset of investors. You really have to be a believer, and you have to be really able to live with this for a very long time.
Okay, interesting. Let me put that into geek language for a second and see if I get it right. If we looked at regression loadings on a long-only value-tilted portfolio, you're going to have a market beta of 1 and maybe a value of 0.2 or something like that. But you're never going to get to a value loading of 1 unless you go long short. Is that a good way to think about it?
Yes, that is good. And again, there are some other, that was just now 2 things. If you start to add some other things, it's again the equity risk there dominates. And again, I think, I mentioned earlier, equities are forgiven that bad decade, and there are good reasons for letting that dominate. But it is, to me, this is not the best possible diversification. I can get more portfolio volatility reduction through combining lots of uncorrelated return sources.
So where is the line between alternative risk premia and alpha?
Yeah. So, there used to be this alpha and beta distinction, and then people added alternative risk premia in the middle. So both alternative risk premia and alpha, they are uncorrelated from the market exposures, or somewhat uncorrelated anyway. But the difference between those two is that this sort of pure alpha is proprietary and manager specific, and this alternative risk premia, they are widely known and systematic. So prime examples would be the kind of styles we talked about: long short, value, momentum, carry, defensive, so I think that widely known, systematic are the key points. And this also means that this alternative risk premia, they are more evidence-based. There's a lot of historical support on them in many countries and asset classes. I think manager-specific alpha is more beliefs-based. You rely on a particular manager and your own ability to have picked a good manager, and often that's influenced by recent track record. And so anyway, you hear where my leanings lie.
Yeah. You very briefly touched on this, but I want to dig into it a little bit more. Do you think investors are as patient waiting for alternative risk premium as they are waiting for the equity risk premium?
Yeah. Okay, so equities are the only risk which are forgiven a bad decade. I think that's, it's a cliche, but it's important. There's greater patience by investors, thanks for good reasons, good and bad, I would say. So great empirical evidence, good theoretical justifications, bad returns in bad times. It just makes sense that this is a meaningful risk. Conventionality helps. You can lose money sometime a lot, but you are in the same boat with others. Embedded leverage there. So these all help. They give, I think, the even in my mind now, like this justification for holding those equity-dominated portfolios, unless you have got such conviction on the diversification benefits of some lowly correlated style Premia that you wanna sort of go that way.
I have a practical question for you. What are some of the things that investors can do to stick with investment strategies during periods of poor performance?
Yeah. So in the background there is this issue of investor impatience. Investors require more consistent performance than is feasible in competitive markets, and this is again even with equities, but certainly with anything less conventional, we get even more this problem. Can be a factor, can be a manager, can be anything, and we know that we need very long data to truly distinguish luck from skill or whether a factor is positively rewarded. But few investors have the patience for this. But strategy is good only if you can stick with it, and in that spirit, I emphasize the importance of identifying the strategies that are consistent with your beliefs and that you can then stick with. And for many, that answer may be that, okay, really, let's let equity conventional risk dominate. By the way, it sounded like it's a binary choice. Then I think one can do some of these other interesting things, but size them modestly so that you don't then capitulate too quickly. But what I also do in the book is I suspect that most investors look in the mirror and like to see their patient long horizon investor, and I try to then cultivate that patience. And so I give some ideas. So I think being educated about both the empirical evidence and theoretical rationales for anything, they can help sustain patience in bad times. And I suggest some practical tips, such as viewing your portfolio broadly and rarely. So broadly means that you don't fall to the line item thinking or try to reduce the line item thinking type of things. And there are tricks for that. Look at return contributions as opposed to, that's return of the asset times portfolio weight, which is a smaller number. That can be helpful. Or when you look at performance of over time, you have to probably tell last quarter's performance, but put it last as opposed to the first in the list. Start with some long horizon estimate. So it's and again, this doesn't have to be, this shouldn't be done without explaining this to let's say your client. That the client should know that we are doing this together so that we are cultivating better long run behavior, and then I think it makes all the sense in the world.
Now, on sticking with a strategy, something that we heard a lot through the value drawdown was, okay, the evidence is there, fine, but the world has changed, and so value is not going to work anymore. And you touched on this earlier. What would you have said to that? Yeah,
I think it's a fair concern when a strategy has a particularly bad performance, but it's also a predictable overreaction by impatient, doubting investors. So one has to, not totally given. Equities were dead in 1979, value in 2020. We should worry about the structural changes, but we should also recall that the value strategy tended to work 200 years through lots of structural changes, technological breakthroughs, and so on. Again, suffering in those times, but they didn't stop value from working in the long run. And very often markets took things too far. So, new age thinking, this time is different type of mentality, took valuations, I would argue, to irrational levels sometimes. So that's often the time when such discussions are, but that's maybe too self-serving. Sometimes that concern is fair and it should be addressed sort of seriously. But I do think that in the current situation, we have seen that type of irrational behavior, and the current opportunity is quite attractive, and value is not dead.
Should investors be more fee conscious in a low expected return world?
Yes. Fees are mechanically a larger part of the equation in this situation, and I write I write again like a chapter on trading costs and fees, and it is important to be cost conscious. But I also say, just sort of, maybe I stop with just one liner. Cost efficient investing is not minimizing costs. It's still maximizing risk adjusted expected net returns. And so one has to be thoughtful about it. Like there can be a role, for example, for those private assets in some cases. But I think one has to be skeptical. The more expensive products are. Cliff has got this lovely saying, the Asnes law, that there is no investment that is so good that high enough fees can't make it a bad investment experience.
It's a pretty good law.
Yeah.
Can you talk about the premier bad habit, as you call it in the book, that investors should avoid?
Yeah. I think chasing returns at multi-year horizons, when it's typical that mean reversion is more likely. I think like that's another Cliff quote here there, that investors act like momentum investors at reversal horizons, sort of capitulating after 3 to 5 poor years, and that's probably pronounced so for institutions by consultant aid in manager selection process. And so it's related to this investor impatience theme that I've highlighted. And there are many studies that suggest that multi-year return chasing is unhelpful, but it is just, it's human. And I think we just have to try to do better against that challenge. But if the message from statisticians or textbooks or wherever it is that you have to wait 10, 20 years or so on, I do understand that investors roll their eyes. And if it's an underperforming manager that tells that, not a helpful conversation.
Can you say that Cliff line again?
That investors often act like momentum investors at reversal horizons.
That's a very funny geeky joke.
Yeah, because again, just to clarify, if somebody doesn't know, you wanna be a momentum investor at momentum horizon. So momentum tends to work, and this is not for you. This is for the audience. Momentum works up to 1 year when you look at historical data in many asset classes. But after that, you start to get gradually mean reversion tendencies over multi-year horizons. So you don't want to be a momentum investor at multi-year horizons, and that's the joke there. Yeah,
it's very, very funny, very geeky and very funny.
And Cliff doesn't like explaining jokes; it sort of spoils them. So I've just done that. Yeah.
What are some of the other bad habits that investors should be cautious of?
Yeah, so I think I list things like under diversification, the cycles of fear and greed. But the one I emphasize most then after this is overconfidence, sort of, because obviously like the direct impact is sort of over trading, but there are many other problems, sort of bad behaviors, bad habits that are exacerbated by that. You don't learn as well, for example, from any mistakes when you are overconfident. Maybe I'll say here that so many of these ideas they are coming from behavioral finance literature, and I think that can be very helpful. But I would say that they are often used to motivate strategies how you can exploit other investors' mistakes. But the best role really should be self-improvement. Good long-run performance requires good investments and good investors. So let's just start with that. Let's strive to improve, our patience, consistency, discipline, I say stable confidence, these types of considerations.
We understand that Ken French, who's our guest in episode 100 and who we know indirectly, at least through our relationship with Dimensional, that he's had a big impact on your life. Can you tell us about that?
Yeah. I guess in most people's lives, or many people's lives, there's a sliding doors moment, this kind of crossroads where your future takes one path. And with me, that was 1989 when I met early in the year. I met Ken French. I was a young portfolio manager in Finnish Central Bank, and he liked me enough that he encouraged me to come and study finance, PhD at the University of Chicago. And he asked me how old I am, and I was getting 28 soon. And he said, well, you're pretty old, and we've got lots of young people there, and you might want to come soon. And so I did, and I applied, and likely aided by his good words, I began my studies that same fall. And that first year, it changed the rest of my life in three wonderful ways. So the education, I mean, the learning curve in the first year is still, I don't know, it's sort of almost like a drug, the thrill, and it was the basis of my finance career subsequently. I also met my German wife who was doing MBA there, and a year later she would have been gone. We wouldn't have ever met. So that's there. And then I met my fellow students, Cliff Asness, John Liu, among them, and they later co-founded AQR, which I joined then much later, a decade ago, finding my natural home. So I'm thinking, Ken French has had a big impact on many lives, but I think few as dramatic as mine. So I'm forever grateful. Actually, I did feel very lucky. Like when Pharma had the Nobel Prize, I got myself away to get in Sweden myself to that Nobel Prize event, and met Ken there, and I told him this, and I was just glad that I had that chance.
Wow,
that's an incredible story, Antti. Thanks for sharing. Our final question: how do you define success in your life?
Yeah, I think I'm a diversifier, so it's a balance is the key. Balance, it's work and family, but there's balancing my soft Nordic values with the harder, more rational University of Chicago and finance career values. So those are important when I think of success. And then on this giving something back, on that front, I don't know, maybe it's a lazy way of thinking about it, but I do think that my best contributions are related to this financial education, these books. I'm proud of them, and hope they'll help investors, and that's something which has given me big joy. Not quite as much joy as my two children, but I show my picture of my two books almost as if my two children.
Well, congratulations on this book. I'm holding it up for those on YouTube. It's just a wonderful book, and thank you so much for joining us. This has been a great conversation.
Good. Thanks, guys. Enjoyed, and a really great show. I'm a real regular on it, and so on the audience side, but yeah, wonderful job there. Okay.
Thank you very much.
Respect. Yeah, one thing I was thinking I could have added as a story there that when in Chicago, when I went to the school in the first class that I had, the first year's big class is the pharma class, and I go there. I'm a little older. Cliff is a teaching assistant there, and he's 5 years younger than me, which is sort of awkward. But he's also super smart, and so this is. But sort of for my future, it is important. I got sort of best both from the whatever exams and some paper. I did very well. It was good for my reputation then with pharma, and I think it was good for friends who had sort of helped me in. But also, I think Cliff has since then sort of thought that he's a somewhat smart guy, so he got good impression on me. And when I think of the career implications of that one, it has been something. So anyway, that part I left out now. So
very cool.
Great.
Is it okay if we include that story at the end of the episode?
As like you want to mention that, or you want me to tell?
No, but we'll just cut in.
Yeah, you can tell the story there. Yeah,
because that is a cool story.
Yeah. It is. It's a funny one.